All right, Mauricio, it's great to meet you. Glad to do this today. And there's a lot of questions in the world of syndication. And I know you've been doing a lot of stuff, putting out a lot of valuable content on how to do syndication correctly. And you mentioned your 8 steps to a safe syndication. So if you would, just tell us a little bit about who you are, what you're doing, and then maybe we'll just jump right in and take people through the process of a syndication from property, LOI, under contract, all the way through entity structure and how everything happens.
Yeah, so I am an attorney, so don't hold that against me. People joke that I'm not your typical lawyer though, so most people joke that I'm either the anti-lawyer or my good friend Tom Wheelwright likes to say that I'm one of the few lawyers that actually speaks English.
Yeah.
So I've determined, I think that's my secret sauce. Kyle Wilson calls about a secret sauce or your unique ability, but one of the things I do well, I think, is take these complex legal structures or legal concepts, especially in the world of syndication, and then distill it in sort of a simple manner so that people can understand. Most lawyers, which I hopefully not training any lawyers, I'm not a huge fan of lawyers. They tend to, talk over your head, or they try and sound smart, and then you're listening to these lawyers, you don't really understand what the hell they're saying. And so I really make an effort to really not use legal jargon and just make it really, really simple to understand. But yeah, I've been doing this now. It'll be 20 years in October, which is crazy. I started in 1999, started at a law firm, did litigation. So securities litigation. So I represented sort of the JP Morgans and the Merrill Lynches of the world. But I did litigation. So it was like, when I got a case, there was a lawsuit already happening. And so I was in court. I did depositions and motions and trials and arbitrations and all that kind of stuff. And then I left that about 8 years into it, just because the law firm life it pays well, but it's a little bit stressful, and it's not something I want to do for the rest of my life. And fortunately, I found the Rich Dad Poor Dad book, so that kind of changed my world, not only my thinking, but also introduced me to the real estate guys, which is who I'm really affiliated with, and went to work for them. That's kind of what was my out. Like, I got out of law firm, went to work for the real estate guys, doing all their syndications, doing all their asset protection, and then just started my own practice from there. So I kind of built my little practice. So I started my Premier Law Group back in 2006. And, when you start a law firm, you got to do whatever, puts food on the table. But as things have gone on, I limited myself, or really focused on asset protection and syndication work. And then about 8 years ago, just decided I was just going to practice exclusively on the syndication side. So right now, 100% of my practice is syndication, and 100% of my clients are real estate investors. I want to say 100% of my work is real estate, but I've got a couple of real estate investors that went out and did some wacky stuff. So I did a cryptocurrency fund last year.
Oh, wow.
And one guy do some options trading thing or whatever. So 99% of my stuff is real estate. But so that's what I've been doing now, and just really enjoying it, and just really focusing now on really value adding. I've just, again, through some coaching, just kind of realized that's kind of, like I said, my secret sauce. And so I've just been, if you follow me on Facebook or you see me, I'm dropping, trying to just add value on Facebook, and I started a YouTube channel and just trying to educate people.
Yeah.
And that works really well. I mean, you educate folks and add value to them, and some of them think of you when they need one, and that's kind of how I really get my business, is just by adding value to others.
Yeah, and it seems like you've been really busy doing that this year, speaking at a lot of different conferences and a lot of different meetings and meetups, and it's really awesome that you're willing to do that and share, because there is a lot going on out there. There's a lot of different opinions. You've made a lot of videos on how to safely raise capital, and there's a lot of people that are just raising capital and keeping them out of trouble. And I think there's going to be some pain coming down the road with some of these syndications that I've seen that might blow up. And that's when the trouble starts. When a deal blows up, that's when everybody starts calling the SEC, and starts calling their attorneys, and everybody starts digging in, looking at the paperwork, following the money. And that's where everything happens. Now, generally, nobody's going to go to jail, but there's going to be some big fines. They might be barred from being able to raise money ever again, things like that. So I think it's really awesome that you're out there saying, hey guys, there is a process, there is a way to do this, and there's a way not to. And then also the asset protection side, I think, is what makes you really unique as well. A lot of SEC attorneys, syndication attorneys, don't have a full grasp of the law when it comes to asset protection. And every state's different, obviously, but there's some general concepts overall, whether to use a series LLC or one LLC or those types of things. But anyways, we could talk all day about all that stuff. So why don't we jump in and just take a case study? So here I am. I've got a $40 million apartment complex under LOI. getting ready to go to contract on it. We're negotiating the last bits and pieces of the contract. And so what do I do now?
Well, if you're syndicating the deal, you want to make sure you call the attorney probably around this time. So I used to tell people to call me, when they enter into LOI, because if you call me before, we're talking hypotheticals, right? We don't have a property, we don't know how much money you need to raise or what the plan is, and we don't have any info.
So no, this is a real deal. So let's say it's a $40 million deal. Okay. And I need to raise, let's say, 30% of that. So I've got to raise $12 million. And I'm already down that road. You and I have, we've worked on negotiating the contract and the structure. So I'm ready to roll. I'm ready to go ahead and put the syndication together, the PPM, the filing, all that.
Yep. So the first thing we're going to do, assuming we've never worked together, which is a real case study, we've not worked together, full disclosure. The first thing we're going to do is we're going to figure out how we're going to raise this money. What exemption are we going to rely on? Because that'll dictate what we can and cannot do down the road. Think of it as a timeline. You just got in a contract or an LOI. You're going to do all this stuff. You're going to raise the money. You're going to close on the property. You're going to do all that. There's like a timeline. And what we can and cannot do in that timeline is going to be predicated on what exemption we rely on. And as a quick recap, for those of you who haven't seen any of my videos, whenever you're raising money and you're syndicating, you either need to register that syndication or you need to find an exemption or it's illegal. So for various reasons, we won't get into it. You don't want to register it. You obviously don't want to do an illegal one. So we have to find the right exemption. That's what we're going to do first. And that's typically going to be pivoted on whether you plan on advertising or not. Because if you advertise, you say, yeah, I want to go on Facebook or I want to go on podcasts or I want to do these webinars or whatever, and I want to really go after people I don't know, then that's going to limit us to what exemption we can rely on. That's typically going to be what we call a 506C as in Charlie. And that's a nice exemption because it does allow us to raise an unlimited amount of money. So you can 20 million, 100 million, whatever, it doesn't matter. It does allow you to advertise and solicit, so you can do all that great stuff. Your main limitations are going to be you can only accept accredited investors, right? So only people who have $1 million in net worth, excluding their primary residence, or $200,000 the last couple of years with a reasonable expectation of earning that much this year. And if you're married, that's 300 grand. And if you're cool with that, if you're good with, hey, I'm only going to go after accrediteds and we're going to verify, we have to take reasonable steps to verify. So we can't take their word for it. We got to look at tax returns, look at property valuations, what have you. And there are third-party companies that do that for you. Then if that's the route you want to go, great. Now you can go do whatever you want, go on podcasts, do videos, and we don't really worry about too much on that side. If on the other hand, you say, well, Mauricio, I've got a couple of, people that I know are non-accredited and, I want to have my mom in here, or I've got my buddy Johnny who I know I want them to participate, then we can't do that exemption. We cannot advertise, right? So we're going to probably do a 506B, which will allow you to take a limited amount of non-accrediteds, 35 to be exact, but you can't advertise, right? You cannot go on social media. You cannot do all this. You really have to really rely on your existing network at that point, people you have existing relationships with in order to, pitch them your deal. So that's the first thing we're going to figure out, what exemption we're going to go with, and then we're going to talk about what you can and cannot do with that exemption as you go through.
Okay, so what about crowdfunding it with a Reg A or something like that where anybody can get involved?
So those are technically two different things. So when you think of crowdfunding, just think 506C, right? So
right.
Crowdfunding is 506C, which we just talked about. Reg A, or really Reg A plus, is something people are starting to use a little bit more because of the new rules that came out a couple of years ago. It does, the nice thing about, let me tell you the nice things about a Reg A if you wanted to go that route. The nice thing about a Reg A plus is you're limited. You can only raise 50 mil. So you're still good. If you raise 50 mil, the nice thing is that you can actually advertise just like a 506C, but you can also take non-accredited investors with some limitations. Like you can only actually take 10% of their money. 10% of their money, their income or net worth, whatever's greatest, right? So there are some limitations, but you have access to the non-accredited investors, which is nice. The downside of the Reg A is, number one, it's not a full-blown registration, but you do have to do a mini registration with the SEC. So that takes time. That's going to take you 6 months, 7 months. So I don't know what your closing date is, but if your closing date is within, 30, 60, 90 days or 120 days, you're not going to have time to go through that, right? So that does typically not work if you're closing on a specific deal. But let's assume you want to do a fund, or, for some reason you've gotten a ton of time, whatever. This isn't not
yeah, so let's ask that. So can that be set up in advance of the identification of a property? Okay. So I can say, hey, I want to do a Reg A. I can start the process now, because 50 million for everybody who's listening or watching, that'll buy a $200 to $250 million property. So 50 million is not too shabby for most people that are going to be watching this.
Yeah, it's great. So if you want to do it ahead of time, you could do that. So you would number one, go through the process, which takes about 6 months. You would pay a little bit more because now the attorney has to interact with the government lawyers, and what happens is the lawyers will look at your submission. They'll get some comments back in about 30 days. You kind of revise things, and you kind of are on the phone and negotiating. And you go back and forth basically for 6 months. But unfortunately, as you know, the government doesn't get back to you the next day. They take weeks and weeks and weeks to get back to you. But so there's a lot of interaction. So what happens is your cost becomes way more expensive than if you just did a 506B or 506C.
Right. So a standard 506B or C is going to be 10 to 20,000, depending on what's going on, right? So Reg A is going to be what, 30 to 50?
I would say actually on the legal fees, maybe, but then you've got other fees. So I would say more like 60 to 75.
60 to 75. Okay.
Compliance, that's the other negative, is you have a bunch of compliance. And again, you're not a public company, so you don't have all those, 10 Qs or whatever they're called. But you do have annual reports, audited financials, quarterly reports, exit reports, intro report. There's a bunch of compliance, basically.
Yeah, and there's fund administrators that'll handle all that for you. So yeah, so that could be.
Yeah, don't get overwhelmed. When I say you have to do all the stuff, don't get overwhelmed. Yeah. You don't have to do anything. Just like the verification, you don't have to do the verification. You don't have to ask for people's tax returns and figure out.
Right.
You can, and it's really inexpensive actually, the verification piece. The compliance piece is a little bit more expensive. And again, I think the biggest piece is going to be your audited financials.
Right.
Depending on how much that, as you guys know, that's not cheap. And if you're doing a startup that has 2 years worth of, that's going to be different than if you're doing a construction project that isn't going to be.
Okay. Well, cool. Well, that's a great option. It's good to know that that's there, but most people are going to choose that Reg C, right? So 506C is what most people are going to go after. So let's go down that path.
Most people are going to do a B, actually. So
or a B, I mean.
Yeah, B, I think the last time I saw 90% of people are doing Bs and 10% are doing Cs. So most people do a 506B, so they won't be able to advertise. They can take non-accredited. So once we make that decision, we'll kind of talk about what you can and cannot do. You'll go off and hopefully not start raising capital from scratch. Hopefully you've got a list and you can start putting together your business plan, which on your end, we'll actually split at that point. You'll start working on your business plan, right? People call it a pitch deck or an executive summary or whatever you call it, but you get working on that. And then I get working on putting the entities together, right? So while you're doing the pitch deck, I'm going to set up the LLC. We've already talked about in our first call whether we need a management company. We'll figure out what entities we need to create, and we'll then start that process of creating, because that sometimes takes time depending on the state you're in. And then we need to set up bank accounts, and we need that whole process going so that when you're ready, everything's set up and you can start receiving money. So I'm working on that. You're working on the business plan. But my real initial engagement, and when I say engagement, meaning talking to you in depth, is reviewing that business plan.
Right.
So I will take your business plan and I will have 1,000 questions and 1,000 comments, and I'll underwrite it. I'll go line by line. We'll get on a phone call. We'll go through all those. You then go back and put together your second draft based on my comments. You send it back to me. Now, hopefully, I only have 100 questions and 100 comments. And so we'll rinse and repeat that, and it just depends on what you end up giving me. I've got clients that I've done 30 syndications with, so then they give me something. We've already worked together, so it's basically I spend an hour on it and we're done. I have other folks that give me a 2-page Word document that's like nothing, and so we're basically starting from scratch. So you're probably going to be somewhere in the middle, maybe closer to a complete because you've got a lot of experience. But I don't know how long that process takes, back and forth, getting it done.
Right.
Once it's done, once it's locked, I call it locked. Once it's locked and we're ready basically to send it out to your investors, you can actually send that out to investors. Right now, you've got your final business plan. You send that out to your investors, and then you do whatever it is that you want to do, whether it's a webinar that you want to put together to talk about a deal, or you're just going to mail it to your people and you're going to get on the phone and whatever your methodology of raising the capital, you're going to go do that with the business plan, which is really your marketing piece. Right? That's really what's going to sell the deal. And then at that point, I now have all the information I need because I've been on the phone multiple times. I've pulled out all the information I need. We've gone through the business plan. I understand your deal, blah, blah, blah. We can now draft the legal documents, right? And the legal documents are essentially the private placement memorandum, which is the PPM, that basically has all the risks disclosed, all the other disclosures we need to make. Very similar to a medical consent form, right? You go to the doctor, you're going to have surgery. Actually, I always give the example. I've done it twice now. I have terrible teeth, and so I've actually had, I think, 3 or 4 oral surgeries. But my last one was not too long ago, and the same thing happened. So you go into oral surgery, I get the little medical consent form saying all the ways that my oral surgery can go south: infection, bleeding, but death, right? 1 in a bazillion. That's what the PPM is. It's a scary document if you've never seen one before. I kind of joke that you have to oversell them on the business plan so that when they see the PPM and they get a little bit scared, they won't get you too scared.
Yep.
you can do a good job of prepping them for that. So when they say, look, it's a legal document, whatever, it has to be done, you can prep them. But I draft the PPM. I also draft the operating agreement for that LLC that we've created to own the property. We create a subscription agreement. We create an investor questionnaire. Assuming it's a 506B, you can self-certify, so that gives us the information we need. We want to keep track and make sure we don't have more than 35 of those. And then your business plan becomes part of that PPM package. I call it the offering documents. And then depending on the structure, we may have some additional documents. So sometimes we set up a sort of a loan structure. So we may have a promissory note as one of the exhibits. If it's a TIC structure somewhere, then we may have a TIC agreement. So there may be other documents in there, but those are typically the offering documents, so to speak, the PPM, operating agreement, subscription agreement, and questionnaire and business plan. Once I'm done with that, I'll send that to you. That'll cure insomnia, right? It's like 150 pages of docs, of legal docs. I honestly don't know if my clients go through that line by line. I think some of them do. Most of them probably don't. I don't typically get that much feedback other than, hey, you missed a comma, you misspelled my name, or, hopefully the purpose really is just make sure I didn't blow anything major. Hey, I'm buying a mobile home park, idiot. I'm not buying a mobile, I'm not buying a self-storage or whatever.
Yeah.
And so usually a one draft, you'll come back with a few comments. We'll put those in the final, send those back to you. And then that's what you would send to your investors that have raised their hand, right? You don't want to send it to everyone. It's like, who's raised their hand, who's interested, who's told you, yeah, so maybe soft commit, I'm going to put in 100 grand, send me the docs. You send all those docs to the investors. And at that point, if they read it or they don't read it or whatever, they'll sign that, send those back to you. And some people do DocuSign, some people do old school. There's really no right or wrong way of doing it. But essentially they read and sign those, send those back to you, and then wire you money typically, although I've got a client who lives in the world that really banks don't exist, so they write a physical check and whatever, check, wire.
As long as it's not a wheelbarrow of cash. That's the only thing. The paper bags and the wheelbarrow show up, I'm out of there.
Cryptocurrency, maybe.
All right, so we've got all that. So let's talk about the legal structure a little bit. So we've set up an LLC that is the operating entity where the general partners are the members. So then what's underneath that? Where do the LPs go? Where do the properties go? And what states are all these filed in?
So I think, I don't know if I do it upside down or not, but in my org chart, the property's at the bottom and the people are at the top.
Okay.
Right? So let's go from bottom to top. So you have the property, right? So your property is located where? If you want to share, if you don't want to share, if you don't share, but give me a state where your property is located.
Yeah, Florida.
Florida. So we would create a Florida LLC to own that property, right? You could set it up anywhere, but because the property's in Florida, you ultimately have to register in Florida anyway.
Okay.
If something happens to that property, Florida law is going to apply. So there's really no benefit to set it up anywhere else. You create your Florida LLC to own the property. Okay?
Right.
Your investors and you, whatever you means, we'll talk about that in a second, will become members of that Florida LLC.
Okay.
The way I structure it, which I think most people do, so I don't want to take credit like this is some great thing. I typically split the ownership into two separate classes, right? I have Class A members. Remember, this is an LLC, so they don't have shares. They have membership or membership units, really members. So Class A members, I have your passive investors. And then I have Class B members, which would be you or your sponsor team, whoever, if you have a co-sponsor. Well, let's just say it's you individually, so you would be a Class B member.
Right.
Then separate from that, every LLC needs a manager, right? Just like every corporation needs a president or board of directors, not technically a president, but they need a board of directors. They need officers, actually do need officers. An LLC needs a manager. So we always have a management company, which is usually an LLC. That one gets created typically in the state where you reside because that's where the business is happening. So even though your property might be in Florida, remind me where you are. I don't even know where
Virginia.
Virginia. So even though the property's in Florida, most of your decisions are going to happen while you're in your office or in home in Virginia. So you're really doing business in Virginia. And so we would either create an LLC in Virginia that manages the LLC, or ideally you already have a company in place. So if this is your first time doing it, which I know it's not, if it was your first time, I would say, let's create a company, a real estate company. That's the face of your company where you have business cards, website. Like when you're at events and you're passing out this, your business card, you're going to be the president or whatever of this real estate company. Let's call it Real Estate Group LLC. That same Real Estate Group LLC can be used for all of your syndications as the manager. So if you already have that set up, then I would use Real Estate Group LLC to be the manager of the Florida LLC. And if you if you already have one, hopefully it's set up in the right state or whatever, we can use that. And if there's multiple sponsors, then either, let's say you and I are doing a deal together. Let's say I'm a partner of yours in this deal. We can do one of two things. We could co-manage that LLC where your management company, your real estate company is one co-manager and my company is the other co-manager. Or we could create another separate LLC that the two of us own. So we have one manager that you and us own. That's just a decision. And I think it really dictates is how many deals do we plan on doing together? Because we're going to go do 5 or 6 or 7 of those. These, I would say, let's create a brand new LLC. If I'm not sure, this may be a one-off, whatever. I don't even like you, but you're a good guy, so I'm going to do it. Then we'll maybe keep it separate.
Right.
That's basically the structure. Now, very important, this would maybe a good segue to the asset protection piece. It's very important to segregate your management company, where that's where all the liability is. That's where all the decisions are being made, right? You're the manager. Think of that as the president. You're making all the decisions. So if somebody questions that decision, that's really the company that should be sued, is that management LLC, right? It's very important to separate that from your assets, right? Because if that company gets sued, we actually want it to get sued. If anybody's going to get sued, we want that company to say, you don't want that company owning anything. Right? You don't want it to own property. You don't want it to own anything. So at most, it would have 2 things. One, an insurance policy in place, hopefully. That's number 1, which is an asset. And number 2, obviously a bank account with some operating cash, right? You need to operate your business, so you're going to have 3 months, however much operating capital you want to have in there.
And your management fees and acquisition fees are what flow to that entity that then get distributed to the members.
That's right. So if you get a nice big acquisition fee at close, all that money is going to go to the management company, and I would get that out of there as quickly as possible. Again, just retain whatever operational you need. But if you suddenly get, $500,000 in there and you only need $100,000 to run the company for the next 3 months, then put the $500,000 in, distribute that to you as the owner for $400,000. So get it out of that company, because think of that as a red company. It's liability. It's a liability producing entity. We don't want anything there, because anything that we have in there is exposed.
Right.
So one of the mistakes I see a lot, and that's one of the reasons the GP, if you don't do it right, a GP-LP structure is not great, because the GP, as you know, is kind of like the equivalent of the manager, and the GP would actually owns a third or 20% of the Florida LLC, which is a bad thing. But the mistake I see is having the same entity or the same people be the manager of that Florida LLC and also be the owner, the Class B. We always want to separate those. And so we have separate companies. One's like I said, the Real Estate Group LLC. And then most people should have what I call a holding company, which is a company that does no business. It's typically set up in a state that has really good asset protection laws. So that these are the ones that you see in Nevada or Wyoming or Delaware. And it does nothing but sit there holding asset. That's why it's called a holding company. And they only hold safe assets. So you would not be putting property in there where people can sue you. You would not be putting a car. You would be putting cash, precious metals, other LLCs. So it's okay to put your Florida LLC ownership in, because it's basically an LLC certificate. Think of it that way. I'm not worried about your cash jumping out and suing you. I'm not worried about your precious metals, your art collection, any of that stuff. And I'm not worried about the Florida LLC stock certificates. Think of that.
Okay. So that Florida LLC that the property is held in, that holding company LLC is going to hold that LLC, but it doesn't actually hold title to the property.
Correct. And that Florida company that owns a property, it's also a red LLC, because if something happens to the property, that LLC is going to be responsible. If somebody slips and falls or gets shot or whatever,
now
that LLC is going to be responsible.
So are the LP investors members of that LLC at the property level, or is there an LLC above that where the GP and the LP investors are the members of the LLC?
So I'm going to take a step back, because I want to now I totally get that people use the terminology, and it's a vernacular, and I use it too, because that's what people are used to. But remember, when you talk about GP and LP, that's used in a structure where you have a limited partnership.
Right.
LLCs, limited liability companies. So the equivalent would be, instead of having a GP, you would have a manager. That's the equivalent of the GP. And instead of having an LP, you have members.
Okay, the members.
So the members, or in this case, if you're thinking of LPs, think of members. They're your Class A members. That's
right.
Is your LPs. Your GP is the manager, right? And in this structure, I guess you have that extra step, which I would actually have also if I did an LP structure. You have the class. Sorry, I just totally lost you there. Make sure. You would have I'm back. You would have your share, your 20%. Let's say it's an 80-20 deal. So you're keeping 20% as your carried interest or your sweat equity, whatever you want to call it. that 20% would be as a member, as an owner. Again, I do a separate class. You would be a Class B member, a Class B owner. Even if I was doing an LP structure, by the way, which sometimes, let me just backtrack. Sometimes I do an LP. I usually don't. But in certain cases, and the main reason I would do it is when I have Canadian investors or Canadian sponsors. So I've got one client who's in Canada. A lot of his investors are from Canada, and Canada doesn't recognize LLCs. And so if you set up an LLC and you give money to Canada, it's like a corporation. They're going to get double taxed. They're not going to be happy. So we would set up a limited partnership where we had LPs, just like now. We'd have LPs are your investors. We would have a GP that's your manager. But I would make that GP 1% owner, or even better, a 0.1% owner, because again, we don't want it to own it. We just want it to manage, or in this case, be the general partner where all the liability is.
Right.
And I would create a separate class. I would have Class A limited partners and Class B limited partners, and that Class B would be your holding company. Your 19% or your 19.9% would be as that Class B limited partnership, because you don't want to have any activity happening at that level. All the activity happens at the GP or management level.
Okay, great. So you have one LLC, that's me. So if I do the deal by myself, I have partners on the GP side. So I'm the Class B, that's my LLC, I'm the manager. And then that goes into the managing Class B member of the property LLC. And then all of the other investors that I raise capital from get named in there individually as Class A members. So there's
however they want to take it. I don't represent them. So some people come in individually. Some people have their own LLCs, holding companies that they want to invest.
But whatever they're using, individual entity, whatever, they're coming in as the Class A members of that LLC. So there's nothing between the property LLC and the management LLC. It
goes property.
Okay.
Florida LLC, class investors.
Yeah. So I've seen some people use management LLC, then a separate LLC that has the Class A and Class B, that then is the member of the property LLC. I've seen one in between there.
I'd like to know what the reasoning behind that, because there's no asset protection benefit. The only time I've seen that that makes sense is if you have another person who's syndicating a big chunk of the money. So if you have let's say you have a deal and I'm like, hey, I can bring in $1 million in my own investors. I can create an LLC. I can go raise $1 million into my LLC, and that LLC then would become a Class A member of your LLC.
Okay.
But
yeah,
if that's not the case, which is typically not. That's just kind of an overkill to do that. Another scenario that I would maybe use that is if I was, I don't want to get too complicated, but if you have foreign investors, and I'm relying on another exemption, which we didn't really talk about, which really doesn't matter because it doesn't even apply. But if you have foreign investors, the SEC doesn't really care about them, right? There's actually an exemption called a Reg S, as in Sam, Regulation S. So if we have foreign investors and we have U.S. investors, I may do that separate layer. So I have an offshore company where all the offshore company investors are. I'll have a U.S. LLC where all my U.S. investors, and then those two would feed into in your Florida LLC. But otherwise, the members just become direct Class A members of the Florida LLC that owns the property.
Yeah, and that's how I do it. So I've got the operating company, and then I have the asset level LLC, and I just keep the two. So I don't keep anything in between them.
And I know it's hard for people listening, and we talked a little bit offline. So in that report you mentioned in the beginning called 8 Critical Steps to Practicing Safe Syndication, which I'm going to send you a copy of, Greg, and that has actually a schematic, a very basic. It'll show you the property and the syndic. I call it a syndication LLC, the management LLC, the holding company, and then your Class A member. So if you reach out to Greg, he'll forward you a copy of that report.
Yeah, that'd be great. So, all right, so we've got all that set up and we're ready to go. So now I get a phone call from John who says, Greg, I can bring $2 million capital to the deal, but I want a piece of the action. So how do I bring a capital raiser into my deal that has investors and he wants to put his investors in my deal and he wants something in exchange for that?
The short answer is you cannot do it that way. If you do it that way, you're going to be acting as a broker dealer. So the rule is you cannot compensate anyone, or you cannot take compensation for raising money unless you are a licensed, SEC licensed broker dealer, which in most cases people are not. And it's a pain to get that thing done anyway. It takes, I don't even know what the details are, but I looked at it a long time ago and it's a pain to get. It's actually cheaper to buy one. But in your case, they're not going to have that. So The only way to really, I don't want to say compensate, but there's two arrangements that you can make.
Right.
One is the one we just talked about, which is Mauricio can bring in and I want to cut of the deal. So what I can do is I can create my own syndication. I can go raise $5 million into let's take your example. I say, Greg, I'm going to raise $5 million into my own LLC. I'm going to comply with all the securities laws at this level. I'll do a 506B or a 506C or whatever I want to do, raise $5 million, and then I'm going to turn around and invest the $5 million in your deal, right? You're raising 12, right? I've got 5. But Greg, man, I'm bringing in 5 mil. I want a better deal,
right?
I'm not bringing in 100 grand or whatever your minimum. So you might be giving everybody else an 8% return. I want a 10% return because I'm bringing in 5 million. And you're probably gonna be like, yeah, that's fine. I mean, you're bringing in 5 mil, almost half of the equity. I'm happy to give you preferential treatment or preferred equity. So I can then take that extra money that you're giving me because I brought in a big deal, and I can take all of that for me at my level, or I can split it with my investors, or I can do whatever I want. But I'm going to get compensated not from you for raising the money. I'm going to get compensated for me putting my own deal together and put it in your deal. That's one way. That's the safest way. There are some other issues you got to worry about, but that's really the safest way to do it. The dangerous way to do it, which is what most people, I want to say try and do, or some people really fail at it. But if I come in and I really am a legitimate co-sponsor in your deal, Mauricio, you know, hey, I know you're doing a multifamily, but let's say you're a self-storage guy and you're like, this is my first multifamily. I don't really know. I mean, I know a little bit about it, but I'm certainly not an expert. Mauricio, you're an expert on this. You've been doing this. Why don't you come in, co-sponsor this with me, help me underwrite, help me do the due diligence, help me do this, help me talk to the lawyers, put the business plan together, be a legitimate co-sponsor. Then we have access to my people. And so then our deal, it's our deal. We're both the issuers. You send it to your list, I send it to my list, and I can definitely do that. But I have to be a legitimate co-sponsor. What most people try and do is they come at it from the different angle, obviously, which is, well, I'm not really a co-sponsor. We're just going to pretend I'm a co-sponsor. Or you're going to list me as a co-sponsor, as a GP, but really I'm bringing in the money. And so then you start trying to assign me tasks, which maybe I'm doing, maybe I'm not, but it's really not a lot. So then the question is that enough? Hey, you're helping me do the investor relations. If I give you that title or that work, is that enough for me to go raise 5 million? So that's kind of the dicey way to do it. You really have to be a legitimate co-sponsor. Your primary duties, your primary responsibilities have to be actually doing the deed, not raising the money. Your substantial and primary duties have to do that. And it's going to be your burden to prove it. Yeah. And it's going to be facts and circumstances. You know, there's no blanket answer because it depends on the fact pattern and how much money you're raising. It's almost like a sliding scale. A great example I was actually at a mastermind, so this is actually a real case where, again, legitimately, there's a sponsor who, he has a limited team and wanted to underwrite additional markets. And so he brought in an engineer who had a full-time job, and he's doing underwriting for him on markets he doesn't have time to look at. So he does the underwriting, and then based on some criteria, he'll send it to the main underwriter if he thinks it's a good deal. And for that, he's getting compensated 2% of the GP, right? Great. Like you get 2% of whatever, and he works at night. I don't know how many hours he spends, but probably not a ton, but a couple hours at night, works on weekends or whatever. He gets 2% for that. Totally legit. You're getting compensated to do underwriting work. And if you want to pay him 2%, great, 20%, great, whatever you want to pay him. Now, if that guy suddenly says, hey, I've got Mauricio and a couple other dudes that are going to come bring in 100 grand or 200 grand to your deal, and they do that, that's certainly fine. That shouldn't be an issue. Even though he's not doing a ton, he's also not bringing a ton. You take those same fact, the same engineer who's doing, a couple hours a night suddenly brings in $2 million in revenue, and now you're giving him 20% of the GP. Now that starts to sound a little bit fishy because now you're only doing a little bit of work, which is the underwriting, and you're getting compensated 20% of the GP, which is a lot, and you just happen to bring in $2 million. That's going to be a tougher sell to the SEC. So the more you're doing of real work, underwriting, due diligence, investor related, the more you're doing, be great if you can show, you're flying to the property, you're walking the 200 units, and you're in charge of the due diligence. The more you can show, and you can say, hey, with a straight face, my primary duties was due diligence and underwriting and investor relations. And yeah, I brought in $1 million or $2 million, but or half of the money. But hey, I'm half of the sponsorship team.
Yeah. So investor relations alone isn't enough. Even though there's a lot of syndicators that have a person that's all they do is investor relations.
Sure. How much does that cost? If you were going to go hire an investor relations guy, was that 50 grand a year, 60 grand? Right? Yeah. So if you're paying me $1 million to do that, that's not going to fly.
Right.
If I'm doing it, that's great, but that's not asset management's a full-time gig, right? So if I'm the asset manager, okay, maybe that's, that's certainly significant. But if I'm the investor relations guy that I can hire for 50 grand a year, why am I paying Mauricio $560,000? Oh, he just happened to bring in $5 million in the deal. That's going to sound a little fishy.
Yeah, so that makes a lot of sense. So for the guy that's raising his own fund, or gal, they have their own syndication and they're bringing that $5 million in for a bigger share of the pref equity, are they now able to get equity as well, not just on the preferred side?
I'm sorry, say that one more time. You lost me there. If I'm a legitimate co-sponsor.
Yep.
Right? Yep.
Well, not a co-sponsor. You're just a capital raiser. You have your own syndication. Yep.
Yeah, sure.
And you're like, hey, I've got you've done your own exemption, your own filing. So you've raised this $5 million, and now you're going to bring it to my deal, and you're going to get that 8% instead of 6% on the preferred return. So do you also share in the equity as well, not just that preferred return?
Good. I mean, it would be,
acquisition fees, equity. Do you share in anything else, or are you just only able to have a spread?
You can have the spread. So I would not be sharing the acquisition fee.
Okay.
Directly. I wouldn't be calling it I'm getting a percentage of your acquisition fee, because now you're paying me to raise money. But what you could do, and we haven't gone this far, there's not too many people who do this, but what you could do is obviously, again, offer them a discount. So again, if I'm putting $5 million, I ordinarily would have gotten, in your case, probably 30% of the deal, but now you're going to give me 35% of the deal, because it basically a discount on the price.
Yeah.
I can make that additional 5% equity for myself, but it would happen at the higher level, right? So
right.
The 30% that they would have gotten anyway, I'm getting the additional bonus because I brought in a big chunk of money and I'm preferred equity. Because, I've definitely dealt with legitimate preferred equity groups, not this kind of trying to figure it out fund to funds.
Yeah.
They get preferred treatment. They get paid out first.
Yep.
It's almost like a loan. They get these, you get these additional fees. And so that's totally fine to give them whatever as long, again, you've got to disclose all of this, number one. Right. You got to remember from a marketing standpoint, how is the guy below them, the investor who's B or A, or, I usually do A1, A2, but whoever's, subordinate to them, how are they going to feel? Like, wait a minute, I'm giving you 100 grand, you're giving me 10. Why are you giving this guy this guy's getting 12? And
right.
The answer's easy, right? The easier, you go raise 5 million. If you bring in 5 million, then I'll give you the same term. So you're technically giving the same terms to everyone. Let's do a more realistic one. I'm doing one right now where they're literally giving 6% on the front end and 6% on the back end. And, but if you bring in 500 grand, then you're going to have a preferred, it's going to be 8 and 8. So and that applies to everyone. So if you
right.
if you bring in 500 grand, great, you're going to get the preferred treatment. Most people can't. And that's why people can pool their money to get the better deal. And ideally, you've just got to be careful. If you're the person doing that, you want to make sure that there's no incentive for that person to go around you and go directly into the deal. And the incentive is typically, the minimum is 500 grand. You don't have 500 grand. That's why I'm putting this together. You're putting 50 grand into my deal. And so you wouldn't have access to the deal if it wasn't for me. That would
right.
be the easiest. Or I'm getting a better deal and I'm giving you a little bit of that. So you would have, even if you went directly, you would have got 8%. Now you're getting 8.2. So it's a better deal anyway that I've negotiated because of the power of the group.
Right. Yeah, that makes a lot of sense. Well, awesome. Well, I think we've covered it A to Z. I'm looking forward to that report, and people know where to reach out to me, and I'll be able to send that to them. But how can people get in touch with you? You've shared a lot of great information today, and I know you're doing a lot to be able to reach out to the investor community to make sure people are doing this right, not just the syndication, but structuring themselves correctly so that they don't get any clawbacks or any legal liability down the road. Of course, anybody can sue anybody, but at the end of the day, if you're structured well and protected correctly, what they can recover can be limited to nothing. So I think that's really cool. So how do people find you? How do they reach out to you?
I appreciate that. So if you want to reach out to me directly, you can always email me at team at premierlawgroup.net. That's kind of a team at premierlawgroup.net is a good email. In terms of getting my content, though, if you want to, Facebook's a good way to connect on me. Just make sure that if you do a friend request on Facebook, also drop me a message. Just say, you heard me on Greg's webinar, or what have you, or you're client or what have you, because I get a lot of requests and a lot of time I just ignore because I don't see any connection. But if I get the message, that's going to be easy. I just started a YouTube channel that I'm trying to add to. And so if you were interested in those videos, just go to YouTube and it's Mauricio Raoul. Would love a subscribe because I just started it. So anything would help. And then my website's premierlawgroup.net, although I don't know if I want to even send you there. I need to work on that. So YouTube, Facebook, or the email are probably the 3 best ways to find me. Yep.
And your YouTube is great. And I think if you take that 8, have you done a video with the 8 steps to a safe syndication?
No, I should. I actually thought I have not.
That'd be a great video. Yeah. Great visual.
great video. I try and keep the videos short, so maybe it would be 8 videos, and each would be like almost like maybe an 8-part video series.
Yeah, yeah.
Because I have one on, so by the way, if you the social media one too. So I've got a social media, which I'm actually gonna release it on Facebook here probably next week, on the do's and don'ts and how to use social media to raise money. For that one, I did like a 5-part video series. So maybe for the 8 critical steps, we just do an 8-part video series, and that's a great idea.
Yeah, that'd be awesome. Well, great. Well, Mauricio, I appreciate you carving some time out today to help everybody, and it's just awesome what you're doing, and we really appreciate it.
No, thanks, Greg. Appreciate you having me on. Looking forward to doing more of these.
Yep. Awesome. We will talk to you soon.
Sounds good. Thanks, Greg.